Welcome to The Explainer. Today, we're going to dig into a company's financial report that, at first glance, seems to tell two completely different stories. And we're going to figure out what this billion-dollar bet from Paychexs is all about.
Okay, let's jump right into Paychexs' big quarter. Now, these guys are a huge deal in the HR and payroll world, so their numbers get a lot of eyeballs. And this time, the results were, well, a little confusing on the surface.
So this is the number that really got everyone talking. A massive 17% jump in their total revenue for the first quarter. And trust me, for a company of this size, that kind of growth is a very big deal.
But here's where things get weird. At the exact same time revenue was soaring up by 17%, their official profit, what accountants call net income, actually went down by 10%. So that leads to a really important question. How on earth can a company bring in so much more cash but end up reporting less profit? It seems like a total contradiction, right? But it's actually a perfect way to understand how big companies talk about their earnings.
Well, the answer really begins with this one giant move Paychexs made. They bought another company called Paycor. And this wasn't just some small purchase. We're talking about a multi-billion-dollar deal that was designed to completely reshape their business.
So where did all that new revenue actually come from? You can see it right here. Their management solutions segment just exploded, jumping a staggering 21%. That was the engine that powered all of the company's growth.
And here's the kicker. Out of that huge 21% jump, the Paycor acquisition was responsible for about 17 percentage points of it. So yeah, nearly all of that impressive growth came from this brand new company they just bought. Okay, this gets us to the absolute heart of the matter. We have to understand the difference between that official profit number, the one that was down 10%, and what the company really wants investors to focus on, something they call adjusted profit. This is where we get into a little bit of finance speak, but stick with me. Let's use an analogy to make this super simple. The official accounting number, or GAAP profit, is kind of like your total spending in the month you buy a house. It includes that massive one-time hit from your down payment, so on paper, it looks like you lost a ton of money. The non-GAAP or adjusted number, though, is like looking at your normal monthly budget without that down payment. It shows if you're financially healthy day to day.
And this table here shows the exact math they're doing. They start with their official operating income, and then they basically tell investors, hey, just add back this $85 million in one-time costs from the Paycor deal. Their whole argument is that this adjusted number gives you a much truer picture of the company's core operational strength.
And you know, these one-time costs are not small potatoes. The biggest chunk, over $61 million, is for something called amortization of intangibles. It's a fancy accounting term, but you can just think of it as the cost of absorbing things like Paycor's brand value and customer relationships onto their own books. And on top of that, you've got millions in employee bonuses and other fees just to get the deal done.
So once you make that one little adjustment for those one-time costs, the entire profit story flips on its head. That scary-looking 10% decline on the left suddenly becomes a pretty healthy 5% increase on the right, and you can bet that is the number Paychexs wants Wall Street to be talking about.
All right, let's zoom out from the numbers and talk strategy. Why would a company spend billions of dollars on a deal that makes its official profits go down, even just in the short term? What's the end game here?
Well, the answer is that they are absolutely playing the long game. This isn't just about buying Paycor's current revenue. They're buying new technology, they're getting access to bigger, more profitable customers, and they're creating a huge opportunity to sell more of their products to a much wider audience. They're trying to supercharge their future.
And you have to remember, this move adds a powerful new engine to a company that's already a recognized leader. They've got a whole history of winning awards for innovation and ethics. The Paycor deal is all about building on that legacy, bringing in fresh tech and expanding their reach. So what does this all mean for the future? Where are things headed? Well, the good news is we don't really have to guess. The company itself is telling us exactly how confident they're feeling after making this huge move. And here is the proof. This table shows their own financial forecast for the full year. They have actually raised their forecast for what's called adjusted diluted EPS, which is just their adjusted profit divided by the number of shares. Bumping up your own forecast like that is a very, very strong signal of confidence to the market.
And you can hear that confidence straight from the top. The company's CEO, John Gibson, he summed it up perfectly. This quote just shows that management isn't worried about some short-term dip in official profits. They're framing this whole acquisition as a critical step toward creating real, long-term value.
So this leaves us with a final thought. This quarter's report is so much more than just a bunch of numbers on a page. It represents a huge, strategic bet on the future of HR technology. And the big question now is, will this billion-dollar bet actually pay off and maybe even redefine the entire industry?